All right, we've got a perfect example right now of what most people do, and I've had a few people already ask me, shouldn't we be in the FANG stocks or the QQQ? And the answer, I've already actually explained this and used the gold market as an example. You don't want to chase these markets that are mature and stretched to the upside. That doesn't mean that there couldn't be a little more upside, but you're playing musical chairs, and if the music stops and you didn't get out in time, you risk getting caught in a correction or even a mini crash. And the stock market, I think, is probably setting up for some kind of a mini crash between now and September. The Fed started QE again, obviously, to save the banking system when it was at risk of failing in March. And a lot of that liquidity, as I've explained in previous videos, went into the stock market and especially into the tech sector. And you can see from this long-term chart just how stretched that QE pushed the market above the long-term 200-day moving average. This is a dangerous situation. When the Fed does something like this, pumps too much liquidity into the market, they stretch price far above these moving averages, and then at some point you get a regression event that drags price back down to the long-term moving averages, and sometimes it does it as a crash event. If the cycle is extremely right translated, then there's not a lot of time for the corrective phase of the cycle. So it very often it has to occur very quickly at the very end of the cycle, and that can be the conditions that spawn a crash or a mini crash. And I think the Fed has probably set the tech market up specifically for a really hard move down into an ICL and probably a daily cycle low here. They're clearly they're trying to rescue the market ahead of the 4th of July holiday. I've gone over this before. These are periods where the government wants the people optimistic. They want them out spending money. So the Fed will pump liquidity into the markets and try and prop the market up ahead of these holidays, and they may have succeeded. The stock market was starting down into its daily cycle low, but it may have been aborted at least temporarily here ahead of the holidays. I think they'll try very hard to keep this propped up into the 4th, but after the 4th, this is going to have to finish, and it may give this all back later this week. They may not be able to keep this propped up, but they're certainly going to try. But either way, the market is just stretched way too far above the 200-day moving average. It's late in a daily cycle. It's getting late in an intermediate cycle, and the Fed has set this market up for a big regression event, something that's going to pull price back down to or close to this 200-day moving average. Now let me switch this over to the weekly chart. All right, so here's the weekly chart, and you can see, again, you can see how far they've stretched this above the 200-week moving average. They've pushed momentum to extremes. So, I mean, we're not as extreme as we were back here. This was all the QE that came out of that 2020 bottom, just caused a huge, this had the potential to turn into a bubble, but I think the Fed started raising rates just in the nick of time. But you can see what happened. There was an extreme regression event that brought price all the way back down to this 200-week moving average. And they've done the same thing. When they started pumping QE in here in the markets to save the banking system, it's triggered another, mini, I guess I could call it maybe a mini bubble. Not really, but they've just stretched price too far above this moving average, and now it's getting late in the daily. It's really late in the daily cycle, and it's getting late in the intermediate cycle. And the tendency for many traders is to want to chase this market. Let me go back to the daily. They want to chase this market because now they're afraid of missing any more of the move. But if you back out on your charts and you see just how extreme the stretch has become above the moving averages, you would understand that now is not the time to give into emotions and want to chase. If this does have a little more upside, it's not worth trying to catch, because you've got that risk that the regression event, when it takes hold, is going to pull this down, back towards this moving average. And as I said, these cycles that right translate to an extreme degree or are at risk of some kind of a mini crash event. We've got that risk right now in the daily cycle. Once this does break the manipulation to keep this market propped up, I think there's a decent shot that the tech sector could come back down to test this pivot here, which would be a pretty big move. But then during the next daily cycle, the intermediate degree decline, a larger degree, and one that's going to last more than just a couple of weeks, there's risk that price comes all the way back down to test and maybe even marginally undercut this 200-day moving average, because they've just allowed, they keep making this mistake. They pump a lot of liquidity into the market, get prices stretched too far above these long-term moving averages, and then the regression event causes a massive and severe correction, and then they're forced to do more QE. So you just get a market that let me go back to the weekly charts. All right, so you get these markets that are just very manic, and you get these big corrections and big rallies, and then probably another crash. We've got the 4-year cycle low coming in 2024, so they are setting this market up for a crash into the 4-year cycle low in 2024 by allowing price to get stretched too far above the moving averages again. So now is not the time to give into your emotions and chase the tech sector with price at risk of a very nasty and hard correction into a daily and an intermediate cycle low. Now is the time to be biding your time, looking for the opportunity that is brewing in the metals sector. We're getting closer. We're getting close to that 38% Fibonacci retracement in gold. I don't know that that's going to be the exact bottom, but it's certainly closer to the bottom than it is to the top. So the opportunity is going to be in gold. That's where the correction is already in play. Once we get a correction here in the stock market, then there'll be another opportunity. But this is not the time to be giving into emotions and chasing, afraid that you're going to miss out on more of the rally. You're probably just going to get caught when the crash occurs. So bide your time, be patient. We're getting closer and closer to that buying opportunity in the metals. And as I said, I'll leave the SMT open for anybody that wants to subscribe, as long as we are in the declining phase of that intermediate cycle in gold, as long as that opportunity is still building. Once we finish that correction, then I will close the SMT to new subscribers.